Hello friends, welcome to my weekly market outlook video. This is the 28th video I'm recording, and 27 weeks out of 28 we've got the market ranges right. In spite of all the volatility, in spite of all the ups and downs, and thank you for such heartwarming response and connections on the social media, your likes and comments. In these videos, I'm attempting to put you ahead of the market by giving you a 360-degree worldview of where the markets are headed, and do note how we've been weeks ahead of the broad consensus. In that tradition, let's continue with these videos and attempt to see where the markets are likely to go in the coming week as well. Now, as the market roundup screen or the market roundup graphic on your screen shows, the markets continued to be under pressure as the bulls labored on. And the Nifty fell 0.22%, whereas the Bank Nifty fell 4.16%. And I don't think there are any price for guessing why. I've been telling you that the bond yields, the inflation, interest rates, and the Dixie will collectively weigh on the markets. And guess what? My hypothesis has been proved right on almost all counts. The USD INR, which shot through the roof last week, was in no small measure responsible for the weakness that was unleashed in the banking stocks. And the Dixie, although it fell 0.91%, the USD INR rose 1.91%, which means the rupee became a relative underperformer as compared to its US dollar and many of its Asian peers. Although emerging market currencies were under pressure, but the rupee significantly was weaker, and that is basically unnerving the banking stocks. Bullion rose as the dollar weakened overseas also, and the flight to safety, which is safe haven buying, was seen in bullion. Oil and gas prices fell, which was a minor mercy, and it managed to slow down the decline in the markets, which otherwise would have been a lot more higher, because oil and gas, as I have been telling you, are multiplier commodities, and when oil and gas prices rise, everything from fruits, vegetable, milk, eggs, etc., everything becomes expensive. Bond yields fell marginally, and we are going to cover that in the bond yield segment just in a bit. And coming up on your screen is the MWPL, the market-wide position limit chart, which shows a steady increase in the MWPL as traders continue to raise their stakes in the market in anticipation of better prices. Now, this is routine after expiry. For at least a fortnight or so after expiry, we have seen historically open interest does tend to go up. So nothing to it. Take a look at the volumes chart. Now these are volumes of index and stock futures. They are cumulative April, May and June series of stocks and indices. It shows the index volumes fell sharply on a week-on-week basis. Though the stock volumes picked up in the last 4 days, the volume still remained lower than the previous week. Now this is very clear that trader interest is subsiding a bit as conviction levels are a little low. Look at the basis chart now. Now basis is nothing but the premium enjoyed by the futures over the spot. Now, Bank Nifty basis closed higher on a week-on-week basis, marginally higher on a week-on-week basis, whereas the Nifty basis actually fell. Now, Bank Nifty basis went up because of short covering, and the Nifty basis basically went up. Nifty basis fell because of the selling pressure and the profit taking, which was seen at advances. The impetus chart is an interesting revelation. Now, look at the interesting juncture impetus is at now. The Bank Nifty impetus is falling. The Bank Nifty is falling in price, but the impetus is rising. This indicates that selling is actually gaining momentum. The impetus should not have risen with the decline in prices. So the fall is gaining momentum. The Nifty, on the other hand, is attempting to rise because last week it rose on all but 2 trading sessions. It's attempting to rise, but the impetus is weak. Now that tells you that buying conviction on the upside is a little weak. However, make no mistakes about it. Given a choice between the Bank Nifty and the Nifty 50, I think it is the Nifty 50 which is relatively stronger. So watch this metric keenly, and these are not studies that you will find anywhere in the public domain. These are our in-house studies, a feature of our in-house trading model, the Barracuda. So I'll keep updating these on my social media pages. Do feel free to connect with me there. The market roundup done, my friends. We now go to the 10-year benchmark bond yields. Now the yields fell on a week-on-week basis because the RBI announced a government securities acquisition program. This is India's version of quantitative easing or a stimulus. This is a bond buyback program, and the RBI has indicated that it will buy $1 trillion worth of bonds from the banks, which means 1 lakh crores every quarter. Now, does it necessarily mean that the RBI will wind up buying 4 lakh crores or $4 trillion worth of bond in a financial year? Because 1 trillion every quarter would translate to 4 trillion every year. It may be so. But then, remember, I've been telling you that the RBI needs to borrow minimum of 12 lakh crores in this financial year as per the budgetary estimate. Which means my suspicion is that this 12 lakh crores will then have to become 16 lakh crores, if not higher. If not higher. Now, if you were to ask me what is spooked the forex markets, I think the forex traders felt that this GSAP or Government Securities Acquisition Program will basically widen the fiscal deficit, and therefore the forex markets marked down the rupee and raised the dollar against the rupee. So that in turn also hammered banking stocks. And I assured you I will keep you ahead, and that is what I'm doing and will keep on doing. Connect with me on social media on a day-to-day basis, and end of the day, do read the analysis that I put up there. Friends, the 10-year bond yields done. We now go to the dollar index, popularly known as the Dixie. Now, this is nothing but the US currency benchmark against a global basket of currencies. Last week, I told you that I see a little bit of easing in the upward momentum, which was proved by the price declining, as you can see on the daily chart on your screen. The price even fell momentarily below its 25-day exponential moving average before closing around that level itself. However, I do feel that the bullishness is not completely over yet, and it's premature to write off the Dixie. The 91.5 level, 91.50, remains a support to watch out for. All emerging markets, including India, need a weak dollar because we are import-dependent countries and we don't want imported inflation due to a strong dollar. So if the dollar remains weak, chances are next week the market could basically see strength and stability returning. The outlook on bullion and energy will also depend on the dollar, because a weak dollar will strengthen both gold, silver and crude and natural gas, all other factors remaining constant. The weekly chart of Dixie shows a large bearish candle that has taken support at the 25-week exponential moving average, which means that the coming week or two will be extremely crucial to watch out for in this benchmark. Now, last week I advocated a range between 94.15 on the upside and 91.90 on the downside, which held perfectly well through all this volatility. The coming week, I estimate a range, remember it's an estimate, between 93.25 on the upside and 91.05 on the downside. I suggest you watch this space very, very keenly. Friends, the dollar index done now. I move to the Bank Nifty, which is at a critical juncture. This index actually underperformed the Nifty 50 by falling harder and faster. And basically, the viewers of my videos would know why. I've been talking about bond yields and interest rates, and here in the Monetary Policy Committee, or the MPC of the RBI, in its announcement on 9th of April, said that they would like to keep interest rates pegged, bank interest rates pegged at 4.25%, and they were targeting inflation at 5%, which meant that the real effective interest rate adjusted for inflation is a negative of 0.5%. That's bearish for banks, which is why the banking index fell. Now, I believe in sharing with my viewers the cause and effect, the reason why what is happening in the markets, so that they can learn to analyze the markets better themselves. Note on the daily chart how this index fell on 4 out of 5 trading sessions, and in the bargain remained below its 25-day exponential moving average, the internal steeper sloping trend line, and also below its previous swing low. That indicates that this index is likely to remain under pressure, and there could be some possible selling on the upsides. The weekly chart, on the other hand, shows that the price still remains above its 25-week exponential moving average, which means the long-term upthrust still remains intact for now. Now, in the week before last, this index was at number 3 on the most volatile list, and last week also it remained at number 3, which means the statistical beta or volatility remains escalated. Now, last week I advocated a range between 35,650 on the upside and 32,050 on the downside, which held perfectly well in spite of all that volatility that you saw in the markets. Now, this validates my system and the output that it gives where levels are concerned. Now, next week I expect an estimated, I emphasize upon the word estimated, range between 34,225 on the upside and 30,650 on the downside. I would suggest my viewers continue to trade light on this index due to the higher volatility in the markets and possibly even higher volatility going ahead. Friends, I now come to the most liquid and low impact cost tradable instrument in the NSE derivative segment, the Nifty 50, which fell mildly compared to the Bank Nifty because it was cushioned by falling oil and gas prices, which I continue to tell you that these are multiplier commodities. Now, this index fell on 2 out of 5 trading sessions, and it traded above its 25-day exponential moving average, as you can see on the daily chart, which is why I say that this index is relatively, compared to the Bank Nifty, relatively better than the Bank Nifty. This index, however, remained below its trend line, and this factor that the index is trading above its 25-day moving average is something that you need to monitor even in the coming week. Watch the metric of this moving average keenly, and here again I do feel that the round number of 15,000 should be overcome on a sustained closing basis, which will possibly lead the markets higher, and the possibility of bear covering coming if the market manages to close above 15,000 for a few days in a row. Bear covering can also basically get triggered. On the other hand, if the index was to fall below 14,300 or 14,350 sustainably, you could see downsides opening up and the index becoming vulnerable to further declines. In the week before last, this index was at number 8 on the most volatile list, but it fell to number 13 because the intraday ranges contracted, which means that the index is now coiling up like a compressed spring for big price action in the coming week or weeks. And that price action could be in either direction. We will have to wait to see which direction, and we'll have to let the price tell us where it's going. The weekly chart shows a doji pattern where the body is small with long shadows. Now this is an indication of indecision, which will be cleared by a clear breakout in either direction, which basically reinforces the outlook even on the daily chart. The price on the weekly chart remains above its 25-week exponential moving average, which means in the long run, the up move still remains intact. Last week, I advocated a range between 15,450 on the upside and 14,300 on the downside, which held perfectly well through all this volatility. And in the coming week, I expect a likely estimated, I stress upon the word estimated, range between 15,400 on the upside and 14,275 on the downside. Here again, I think you should trade on fairly light exposure and focus on capital preservation because of the earnings season kicking in. A lot of volatility might be in the offing. Friends, the Nifty and the Bank Nifty segment done. I now come to the most popular aspect of this video, wherein I recommend 5 stocks for high beta, high impetus traders and 5 stocks for low beta, low impetus traders. In the high beta stocks, you take small exposure, wait for large price move. And in the low beta, low impetus stocks, you take large exposure and wait for small price moves. So the high beta, high impetus stocks list is led by Cadila Healthcare at number 1, Apollo Hospitals at number 2, Adani Ports at number 3, Granules India at number 4, and number 5, Glenmark Pharma. Note, this seems to be the week of healthcare and pharma related stocks which are more volatile. The low beta, low impetus stocks are led by ONGC at number 1, number 2, Hero Honda, number 3, Rural Electrification Corporation or REC, number 4, IOC, Indian Oil Corporation, number 5, Power Finance Corporation or PFC. Here, the common factor is most of these counters are PSUs directly and indirectly related to power and energy. Friends, this hierarchy of low and high beta stocks can change from day to day as volatility goes up and down. Do connect with me on social media. My contact coordinates are coming up at the end of this video so that you can monitor the end of the day statistic that I put up. Very, very simple in layman's language, which tells you what the market is doing and where it is likely to head. Friends, if you like this video, do subscribe to my YouTube channel. If you haven't already done so, click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comments section, I'd love to hear from you. Keep your comments coming in and help me reach out to fellow like-minded traders by referring my video to your family and friends. Coming up on your screen are now my contact coordinates. Feel free to connect with me. Let's have conversations going. Let's help each other become better traders out there. I wish you have a very, very profitable week ahead. Thank you for watching my videos. Vijay Bhambwani signing off for now till we meet again in my next video. Take care. Thank you. Bye-bye.